Welcome to this tutorial video on options trading on PersonalFinanceLab. An option is a contract that gives an investor the right, but not the obligation, to buy or sell a stock at a specific price, called the strike price, before a certain date, called the expiration date. Options are often used to protect against the risk of a rapid drop in price for a stock you're holding. They can also be used to lock in a price to buy a stock before it shoots to the moon, or to add income in a stagnant market. Before we dive into how to place an options trade, we'll review a few key terms you need to know first. There are two types of stock options, a call option and a put option. A call option gives you the right, but not the obligation, to buy the underlying stock at a specific price before the expiration date. If you believe the price of a stock will go up, you could buy a call option to profit from the potential price increase. As the price shoots up, you have the option to buy the underlying stock at the strike price instead of the current market price, or you could just sell the option at the market price. A put option gives you the right, but not the obligation, to sell an underlying stock at the strike price before the expiration date. Imagine having a way to sell a stock at a set price, no matter how low it drops. That's what put options are useful for. If you already own a stock and you're concerned the price might drop, buying a put option will act as a safety net. So if the market price for one of your holdings plummets, put options give you the opportunity to sell the stock at the strike price instead. An option premium is just option lingo for the option price. The premium is mostly influenced by the price of the underlying stock, the volatility of the stock, and the number of days until the contract expires. The buyer of the option pays the premium. The option seller, who is also known as the writer of the option contract, receives the premium. Just like trading stocks, you buy to open when you want to go long or own the option contract, and you sell to close when you want to close an existing position by selling your option contract. Both actions involve making a bet on the price direction of the underlying stock. So, if you think an option price will go up, you buy it, and when you think it will go down, you sell it. Just like you can short a stock, you can also write or sell to open an option. This means instead of having the right to buy or sell a stock at a certain price, you have sold that right to the buyer, who can now buy a stock off you or force you to buy it from them. Buying to close is just like covering a short stock position. It is how you unwind or close your short position. The moneyness of an option contract is determined by the difference between the strike price and the current market price. When a call option is in the money, the market price is higher than the strike price, meaning you have the right to buy the stock at a lower price than it's currently trading at. For a put option to be in the money, the market price of the underlying stock is lower than the strike price, so you can sell your option above the current market price. Out of the money is the opposite. It means there is no intrinsic value to the contract because the market price went in the opposite direction to what you thought it would. In this case, you could let the option expire worthless. Exercising an option means that the holder of the option contract is using their right to buy or sell the underlying stock at the agreed upon price. The seller must fulfill the terms of the contract upon receiving the notice. When the option expires, the holder of the option may exercise the option, or the option may expire worthless and the writer keeps the premium. The reality is that most options are not exercised, but rather just sold back at the current market price during the expiration week. On PersonalFinanceLab, if you do not exercise an option by the expiration date, it will not be exercised for you, meaning the platform will not buy or sell the underlying stocks on your behalf. Instead, your contract will be sold at the last traded price, with any profits automatically added to your virtual portfolio. To make an options trade, go to StockGame on the main menu and click Options. There are two different kinds of option trades you could make: simple or a spread. We'll cover option spreads at the end of this video. You'll start with buying to open, since you'll need to be holding an option before you can sell it. For quantity, each option contract represents 100 shares in the underlying stock. So put 5 if you want the contract to cover 500 shares. Enter the ticker symbol of the company or stock. If you don't know the ticker symbol, start typing the company name in the search box and a list will appear. Then, choose whether this will be a call or a put option. Remember, a call option is to buy, while a put option is to sell. After that, you need to choose the expiration date. Not every date is going to be listed on the drop-down menu. Similarly, the strike price will have a preset list as well. If there isn't a large enough pool of investors who are interested in that option contract in the real world, then your order might not be filled. Keep an eye on any warning messages that appear. If you see a warning message, you'll need to choose a different strike price or expiration date that has more trading activity. The closer to today the expiration date is that you choose, the more likely there will be enough trading volume to complete the order. Choose a strike price that is close to the current market price to get the most trading volume. Click Preview to update your order. You will see an auction payoff diagram that shows you where your profit and loss points are for this stock and for this option. Then you can add any trade notes and click Confirm to place the order. If you're buying or selling to close options, you will always pay or receive cash, so there is no margin requirement. However, if you're writing options, that changes. To protect investors from potential losses, brokerages require investors to maintain an amount of cash or securities in their accounts as a guarantee. This deposit is called a margin requirement. The margin requirement depends on the type of option and the risk of your position. If you write a naked call, which means you sold the call option contract only, your margin requirement would be 20% of the underlying stock plus the premium received. When you sell a covered call or a covered put, the margin requirement will be 0, since you have the collateral to support your position. If you want to use option spreads, click the Spreads tab at the top of the page. Enter the ticker symbol of the underlying stock to get a quote. Depending on which spread type you choose, you'll be following different investing strategies that are explained with diagrams when you select each of them from the drop-down menu. For example, a covered call is a strategy where an investor sells a call option while owning the underlying stock. There are 2 legs in this spread. For every 100 shares of the underlying stock you buy, you will write 1 call option contract. In this case, the strike price should be above the current market price of the stock. This strategy is best used when you expect the stock to trade towards the strike price, but not above it. The profit you could make for a covered call is the premium, plus the difference between the strike price and the purchase price of the underlying stock. Your losses are limited to the purchase price of the stock minus the premium. Once you select the quantity and expiration date, the various legs of the option spread will appear. Based on the spread type, you will need to select strike prices and/or expiration months to proceed with the order. The sequence of the strike prices must be consistent with the spread type. So for example, if you were placing an order for a short condor call spread, the first leg would need to be your lowest strike price, then the second leg would be your second lowest strike price, and so on. All option spreads are executed as market orders. Orders placed outside of market hours will be held until the next market open. Remember that this is a simulation of the financial markets, so if there is high trading volume in the company in the real world, you should be able to place your orders on PersonalFinanceLab for both stocks and options. Here are some other best practices for trading options. Trade options that are near the money or near the price of the underlying stock. If you want to experiment with different option spreads, use different companies for each so you can easily tell them apart. For example, have a covered call on Starbucks, a covered put on Walmart, and a condor on Apple. Spreads are not tied together, so you can reverse one leg of a spread trade. However, this could have an impact on your margin requirements, so make sure to keep an eye on that. If you have any questions, click Contact Us to speak to a member of our team. Our help desk is open from 9 a.m. to 5 p.m. Eastern Standard Time. Outside of those hours, you can create a ticket that will receive updates directly to your messaging center on PersonalFinanceLab. Thanks for watching.